Ladies and gentlemen, good afternoon, good morning, wherever you have tuned in from, and thank you for taking the time to be with us today. My name is Prasenjit Chakrabarti, and I'm a partner in Ketan's M&A practice group. On behalf of the firm, I would like to first extend a big thank you to each one of you for your unflinching support to this entire webinar series, and thank you for tuning in, whether you are from India or abroad. This is the final webinar of our M&A Master Series 2022. We have had an excellent program this year based on feedback from the participants, and we have been thrilled with the tremendous response to this year's M&A Master Series, with literally thousands of registrations for webinars across the series. We are very grateful for your interest and support, which our clients, associates, and others have shown in this webinar. We look forward to your participation and organizing a promising session in 2022. On the next slide is the agenda for today's webinar. If Mitesh, we can go to agenda slide. Yes, that's right. So we will, in short, have a format where we will basically, our expert panel will have a discussion with us on the topics we wish to discuss with them, followed by Q&A session. We have already received several audience questions in advance, and if you do have any questions, do feed them using the facility provided there. If we cannot cover all your questions, rest assured we will reply separately after the webinar, individually to you. Also, please note, after the webinar, you will get a copy of the slide decks, summary note, along with the link to the recording. Moving on to this now, the introduction slide. So what today we will discuss is the trends in technology in M&A. Despite the economic uncertainties of 2022, the pace of mergers and acquisitions in the IT industry doesn't seem to have stymied at all. Technology M&A is at an all-time peak, and despite the global headwinds, we have continued to see a tremendous surge in M&A in tech space. There has been a myriad of factors, right from the COVID, when people were virtually forced to resort to online education, or order food to Zomato, or make payments through fintech applications. That trend has continued. But the fundamental question is, in light of the cost of capital becoming higher, the rate of interest increasing, the global uncertainties, recession looming large in several parts of the world, and really all these headwinds, could it mean that this trend will continue or will it shrink? Well, I think this and all more, including the outlook, a bit of crystal ball gazing, the deal challenges in tech space, all of this we will talk with our expert panel, which takes me to the next slide, which is introducing the expert panel which is here today. Every person who is already registered would have got a detail of full particulars of the panel, so I need not spend much time summarizing their experience. Suffice to say, all of them are excellent, have excellent tech M&A credentials. We are very fortunate to have the three leading M&A practitioners on our panel today, namely S. Sundareshwaran, who is Managing Director at Morgan Stanley, Ms. Swati Senger, Partner at McKinsey, and Ms. Shivani Nagpal, Partner at Ernst & Young. In addition, we have also joined by my fellow partners at Ketan & Company, Karthik Maheshwari, Monica Srivastava, and Nidhi Kilawala. All of them are prolific practitioners in private equity and M&A space, and really have been involved in some of the blockbuster M&A deals, including the very popular Baiju Akash acquisition. So without further ado, I think let us straight away dive into this and kick off our discussions with our panel members. So if I may, I can start off with Swati, Sundar, and Shivani. And there's a bunch of questions really I will ask, so I will kind of request that maybe you take turns to really respond to that. But first is really trend setting. Over the last 12-15 months, how would you describe the technology M&A market in India? That's the first question I have. Then can you tell us about some of the marquee deals, the blockbuster deals in tech M&A space, and which deal you think stands out from your perspective and why? And lastly, which aspects of technology M&A has been most active and why has that been so?
That's Prasenjit. I can get started. Am I audible?
Yes, you are, please.
So, no, I think fantastic, great question. It always helps to look at the rear view mirror. And when we look at the entire, I like to look at an 18-month horizon when you look at the entire technology, M&A and funding. And I would like to break it up into two parts as to what we saw in large parts of 2021 and perhaps quarter 1 of this year and what we're seeing now. But just talking about 2021 and quarter 1 of this year, if you look at any of the metrics, deal value, volume, and what we're looking to cover in this session is largely around consumer internet, fintech, edtech, IT services, and SaaS. That's really the scope of our discussion today. And you evaluate that on the metrics of deal value, volume. Clearly, it was a momentous numbers that one really comes across. And to me, as a practitioner, what one looks at, of course, the volume value numbers speak for themselves, but really how does a deal activity redefine the market landscape or change the competitive dynamic? What does it do to that whole aspect? And when you look at that, and some of the metrics that really stood out for me was, through this process, we had roughly about 65 unicorns in an 18-month or 15-month period. That's very staggering, right? We had roughly about 9 public listings. Again, in this sector, which is redefining itself and getting into it versus, and one of them was in the NASDAQ. So that again defines the category in a certain way. You look at fundraisers and the scale of the fundraisers, right? We had 100 fundraisers which were 100 million or above versus 30 in 2020. Maybe 2020 is not the great example because of COVID impact, but if you look at it even over a broad period of time. And then you had roughly 25 to 30 deals which were 200 million plus. Several of them were again, I would describe as category defining. And the one that you just mentioned, where I think our teams, my colleague Ajay, Salome worked with your teams, was the Akash Baiju deal, right? That just redefined the way the online, offline edtech sector got done. If you take an example of consumer internet, to me, a couple of things stood out. Of course, a large funding rounds that we saw with Swiggy and Flipkart, but also if you look at from an M&A point of view, the Tata deal where they acquired, both Big Basket as well as 1MG, and Reliance Retail's acquisition of Clovia. So we are seeing a lot of the businesses, which are traditional businesses, really making foray and adopting the digital business model. If you look at SaaS, and that's an area that we practice in as a team, and I mentioned the number of unicorns that we saw the funding that happened, and what was interesting for us is that we saw interest across the subsegments, be it MarTech, be it in the area of sales, or improvisation and automation. The deal that we had done, a company called Lead Square is now a unicorn. So the broad-based nature of the bets that we saw people place on the software side, which was very encouraging. And then you move on to tech services, which is the largest deal driver in tech in India specifically. Most of the Indian companies have been buyers. They've been more, if you will, we've seen them place bigger bets. If you look at what Wipro did with Capco and then with Rising, 2 very big bets in consulting. If you look at, and the other thing that stood out for us specifically was the private equity interest. Most of the large deals, be it Carlyle acquiring into Hexaware, Apex, Infogain, name it. I mean, Bearings, the deals that they did, and the sheer amount of private equity bets that have got placed in tech services really speaks to the view of what is a secular growth and value creation opportunity that sits within that segment. So on an overall basis, I think it was 2021, and a large first part of this year was very defining for various categories that we referenced. And at the last 2 quarters, I think the activity is a little muted, to be expected, and for some of the reasons that you just mentioned. But at least our view is that while activity will be muted, there are fundamental and secular trends that will continue to impact M&A. And so I'd love to understand how you're thinking about it.
No, absolutely. I would fully agree with some of the stats, Shivani, that you shared. It's actually pretty impressive, right? The performance of deal value and transactions over the last 2 years, if I include 2022. The way I sort of, you said there are 3 buckets. There's consumer tech, there is IT services, there's SaaS. If I take these one by one, right? In consumer tech, the way I sort of think about the ongoing wave is basically a wave of consolidation, which is manifesting itself in 3 ways, right? One is what Shivani very nicely put it, right? Which is the traditional companies like Tata Digitals and Reliances of the world are now sort of on an acquiring spree to build a super app, right? What we are calling the super app. So that's one. The second one is, the brand roll-up strategy that has become pretty prominent. So when you look at a Mensa, or you look at a Club 10, right, or you look at a Good Glam, their aspiration is to create like a super app, in the process consolidating some of these smaller brands. And the third thing that we are seeing is actually the large digital, companies buying offline presence, right? To build a more omni-channel kind of an identity, which is where Akash from Byju's, of course, and even Farmizi, Thyrocare, right? Those kind of deals actually become very interesting. So that's how I look at it. And all of this is happening primarily, right? In my view, it is happening because of the opportunity to optimize costs, both from a technology standpoint, marketing standpoint, and overall operations standpoint, right? So we are seeing that there is a convergence that is happening towards profitability and now changing the narrative around profitability for the consumer tech companies. So that's on consumer tech. If I look at IT services and SaaS, right, I think we need to first acknowledge the role that India plays in these markets, right? We are talking about a $500 billion IT services market in which India contributes up to 50 to 60%. And that growth rate is not expected to change, because while the global market, grows at 7-8%, India will continue to grow at double digits, right? And in 2021, we saw 15% growth in the IT services market. Of course, it's going to sort of normalize a little bit, but the role of India in both IT services and SaaS is only going to become more and more critical. And the M&A trend that we see in both these spaces is, if I look at IT services, we've done some research which suggests that the intensity of deals in IT services has gone up by 50%. If I look at 2019 to 2022, this 3-year span, vis-a-vis 2016 to 2019. So 50% uplift is actually pretty significant. And what is driving it? If I look at it, if I unpeel the onion, it's basically IT services companies, catching up on the growth game. So most of the companies who are doing these acquisitions, whether it is a Wipro, Capco and Rising, or it is a Tech Mahindra with CTC Co this year, it's basically to develop more niche and digital capabilities, right? Whether it is product engineering, or it is BFSI consulting or SAP consulting. These are capabilities that they did not have, or they were not differentiated on. And now they are on this M&A spree to catch up on these capabilities. On SaaS, I'll probably just close by saying that it is a magnificent space and India has tremendous opportunity. We do believe that in the next couple of years, as we see more and more unicorns in B2B SaaS especially, we will see some kind of a consolidation play. And we are seeing very emerging interest from some of the SaaS companies, which are trying to now double, triple their growth on the back of very capability and IP-led M&A. But again, the numbers speak for themselves. SaaS continues to be, in the low, I think, double-digit, $1 billion in terms of, $1 million. But we do believe that in the next couple of years, that's actually going to, go up significantly.
Excellent. So I think that's a great way to kind of start this webinar. Thanks Shivani and Swati, and I think Sundar is having some tech trouble, ironically, in the tech webinar to join in, but I think we'll loop him in once he is joining in, and we will get his thoughts as well. But in the meantime, let's move forward to Monica. I think for any deal making, the regulatory landscape, how the government formulates its policies are fundamentally important. So can you shed some light about, are there any changes in the offing in terms of government policies which could either adversely or positively impact tech deal making?
Sure. Thanks, Prasenjit. I think on the policy side, I think it's fair to say that the pace of change has been faster in the last few years than what we have seen in earlier years. And that means there's been a number of positive developments which would give the right kind of push to the industry as well as to tech M&A. Equally, there have been areas where important policy decisions or announcements have been anticipated but not been forthcoming, or have not materialized into legislative change. And that means that there's some lack of clarity or uncertainty around those aspects. So let me speak first about some of the highlights in terms of beneficial policy changes. I'm going to stay with the themes that Shivani introduced earlier on in terms of the sub-segments. So I'll pick up fintech first. The introduction of the new umbrella entity framework by RBI is widely considered to be transformational for the retail payment space. If you look at the number, the quality of the consortiums that have come together to make applications under this framework, you'll find that there are top e-commerce companies, payment companies, leading banks, or even leading Indian groups. And all of that just goes on to demonstrate how much promise this regime holds. The second, and an excellent example that comes to mind, which is also specific to technology, is the setting up of the Gujarat International Financial Tech City, and the package of tax incentives that come with it. The third example that I'm going to share is in the edtech space. If you look at the quick rollout of enabling regulatory frameworks in the last 2 years, and all of this happened at the back of the National Education Policy, which was only quite recent. It came out in 2020. I think that framework has been a game changer for the online education market. It has enabled the market to move beyond test prep, supplemental, tutorial sort of education to be able to provide mainstream or formal education in an online format. And that has led to its own cycle of fundraising and M&A by these edtech companies. So there have been some very, very interesting developments at the back of beneficial policy changes. On the other hand, there are several policy areas which leave much to be desired. The first one that would come to anyone's mind is on the data privacy law. Despite a lot of effort, a lot of attempts by the government, lots of debate and discussions with various stakeholders, this law is still very much in the making. What we know is that from latest reports is that this bill is likely to be tabled at the budget session of the parliament, which happens next year. And there's a lot of hope and expectation that it will be comprehensive and leaner. Until that happens, of course, we have to work with the IT Act and the rules around reasonable security practices and sensitive personal data. But I think there's a lot of anticipation around data privacy. The second one, again, very much in the news, very much talked about, is the data localization law, which has been perceived by big tech companies to be a major hindrance. An example that often gets quoted is how RBI expects payment data to be stored in India. And although that data can travel outside of India for processing purposes, it has to be deleted from those systems and returned to India and stored here within 24 hours. Now, requirements like that are naturally cumbersome, but also more importantly, sort of misaligned with the kind of business models that these tech companies are pursuing. The third example I'm going to share in terms of policy changes where there's been a lot of expectation, but there's still, we still don't know where we will land, is the direct offshore listing. If you recall last year, sometime when SPACs were very much in vogue and tech companies had either flipped or were about to flip, there was a lot of conversation around an enabling framework for direct overseas listing. It was even anticipated that this year's budget session would bring out some sort of positive announcements on this. Unfortunately, none of that has happened, and it seems right now this route has been put on hold, and we don't know when it will see the light of the day. So overall, I think as an assessment, I would say in terms of policy change, there have been quite a few hits and a few misses as well.
Thank you, Manika. Though I think my take is there are more hits than misses, so I think that's a silver lining. And I think it's good to see the government being conscious and mindful of the changes required to be brought about to give a more enabling architecture for the M&A tech base to flourish. Moving on, I think to the next question, it's again, deal making is all fascinating, but there are risks, right, with every deal. And my question to Swati and to on this point, and I will request Karthik to also supplement Swati, that what kind of risks you kind of foresee and anticipate and have witnessed in tech M&A deals, and how do you mitigate them? I mean, it's one thing to identify a deal, but it's valuation and whatnot. How do you tackle that? So some lights, if you can share, Swati and Shivani, that would be great.
Absolutely, Prasenjit. From my vantage point, which is essentially helping tech companies think through their M&A strategy and also helping with the integration of the companies. Unfortunately, a lot of focus traditionally has gone towards, HR integration, IT integration, the backend system integration, people integration, right? That is honestly now table stakes, right? You are not doing, and at least many of these acquisitions that we spoke about earlier are not happening because of, purely scale and cost mandates. They're happening for capability building, right? So the risks that I have seen particularly are around two areas. The first one is being able to preserve the capability and the IP that you have acquired, right? Because traditionally, when you look at large companies, they have a different kind of culture. The way they think about capability building, product development is very different. And there comes in, right, a small, more agile a company that you have acquired with fewer people, with very different skill sets, and they have a very different operating model. And we have seen in multiple cases that companies have struggled to fully, integrate the two, which is talent and culture and operating models. So that's the first risk I see. The second risk I see is more from a commercial standpoint, right? Which is, how do you make 1 + 1 is equal to 11 and not 1 + 1 is equal to 2, right? And those synergy unlocks are from the perspective of really integrating the offering, right? What are the gaps that the company is filling, and how does that make your proposition better? So that's one. And second is, from a go-to-market standpoint, how do you enable scaling of that proposition, right? Beyond the customer base that they are bringing and beyond the customer base that you are bringing. So the commercialization of that capability is something that also is very, very difficult. And there are only very few players who have been able to really crack it, right? While maintaining the culture and the talent that comes along with it. Karthik, if you want to add anything from your...
No, I just think on just on general M&A landscape right now, what risks to plan for. I think commercial is obviously one part, which you mentioned. Integration is one part, and preserving the whole capability acquisition story is the other part. I just think tech is not what it was maybe 5, 6, 7 years ago. I think the regulatory landscape has shifted so much now. It's such a fast shifting regulatory landscape now in tech. If you look at any part of tech right now, whether it's fintech, whether it's data privacy, whether it's antitrust, everything is moving so fast, right? So that's one thing you got to plan in M&A. How do you, or just generally any large tech strategic arrangement, how do you preserve your economics? How do you preserve what you plan for with such a fast moving regulatory landscape? Antitrust, right? Frankly, an antitrust approval in India was just taken for granted. I think if you look at the recent BillDesk transaction, everyone's woken up, guys. How well are we prepared from an antitrust perspective? Are we doing the necessary pre-filing consultations with the regulator? Are we talking to CCI in advance? Are we getting informal? Are we really doing all our market surveys? Are we really getting the economists on board early, just to make sure there are no red flags from a competition antitrust perspective? That's one thing to watch out for. I think tech companies are getting smarter there. They know antitrust is something which needs to be factored into M&A transactions, so they're all planning for it now. The other thing is obviously just general regulatory. I mean, if you're let's say an IT consulting business which has a large US footprint, how are you looking for things like immigration law issues? How are you solving for them? Are you red flagging it appropriately? Do you have the right people handling it for you? Things like if you do a little bit of healthcare outsourcing, if you do a bit of healthcare services, like US legislation like HIPAA, how are you handling them? Data privacy, how are you getting customer data to India? How are you handling sensitive personal data in terms of your businesses? How will it be handled post the M&A? I think the one point, and I mean, goes without saying, for a fintech business, how the law's changing, what is the new policy on the anvil, which could have an impact on margins, where could it result in leakage, where could it result in high compliance costs, where can it result in me not using the intermediaries I'm using right now. I think people need to start, and they have started factoring that in. That look, this is not the same industry from 5, 6, 7 years ago. The regulatory sands are shifting too fast. Now, any transaction you do, you've got to plan for that. You've got to plan for contingencies. You've got to do your homework. So I think that's one thing most advisors have been now cognizant of, and most acquirers, and I mean both sellers and buyers are being fair with each other on risk allocation, because I mean there is a fair amount of unknowns and fair amount of complexities here. I think. Prashant, PC, back to you if you want to just move on to the next set.
Excellent. No, I think that's very insightful, Swati and Karthik both. I think Karthik underscored that kind of there's been a constant change with the last 5, 7 years how tech deals are done, which actually leads me very nicely to my next question. I'm very happy I can see Sundar. Thanks, Sundar, for joining in, and good to see you. And so the next question really is about change. How deal making has changed in recent times in the technology M&A space, and what do you foresee in the future? How, especially with the advent of AI, and analytics and whatnot, what kind of changes you foresee and in M&A tech deals? I will also request Shivani to chime in along with Sundar to address this question.
Sure. Are you able to hear me well? I know this is a webinar on tech M&A, so I can't really blame on tech inefficiencies on joining this late, but I mean, I would just put it onto the 5 walls which we have, which is sort of, it took me a lot longer to sort of get in, but very nice to be speaking with you all. Now, just around what we see as changes which are sort of happening from an M&A landscape perspective, right? I mean, clearly, I would say last 2 years have been a bit of an eye-opener. I mean, going into COVID, no one probably anticipated how deal making was going to pan out, right? But going through that, I mean, 2020, 2021, interestingly turned out to be some of the busiest years, right? I mean, one, it sort of proved that, I mean, technology is here to stay. You don't necessarily need to be physically present to do due diligence. And sometimes it also just helps negotiations easier. You can do it still over Zoom or Teams, etc. So there's been a shift in terms of how people have sort of been approached and how people have been historically used to deals. Now, when you look at in terms of the thematics, I think clearly the whole technology piece has become much more integral. What we do see is, while there was a initial phase of deals which were driven by substantial availability of funding, cash type deals, etc., with a sort of a slowdown from a financing environment, what we are sort of seeing is a shift towards more non-cash type of deals, coming together of companies in the same space. There are people who are sort of willing to sort of believe in the synergies of combination. I think one of my co-panelists mentioned earlier about coming together, or 1 + 1 becoming greater than 2. I think clearly some of those things are sort of playing out. And in an environment where the share price volatility has been substantial, I mean, it's much easier to sort of focus on a relative valuation as the basis rather than a absolute dollar number or a INR a number which is there. Clearly, emerging themes around AI, ML, clearly picking up. You're seeing emergence of new trends on the consumer side. You're seeing more D2C brands which are there. There's been a recast or a reset of what used to be traditionally considered as big moats, which are very difficult to sort of break through. But a lot of those things over the last few years have sort of seen changes, which are sort of.
Shivani, you want to supplement that?
Sure. No, I think Sundar made great points on, the whole commercial deal structure part. We do see exactly what Sundar mentioned in terms of the shift between using stock as the currency, stock being a larger component, and in some cases, like the Zomato deal, being all of the consideration, right? So we are seeing that. We are seeing milestone-based payments come in funding, which was not that unique, right? We are also seeing, large deals that are unpriced and following the safe mechanism. So we are seeing some of the deal constructs being a little bit more unique and innovative. If I look at the other aspect, which I think has changed or is changing to a certain extent, is the whole risk aspect of it, right? We are seeing, at least in deals in India, we do a lot of cross-border deals. We use insurance and we do insured deals all the time. But we're seeing that as a more acceptable risk mitigation or allocation basis as well in deals. And I think that helps. We're seeing that in India. We've done it in several of our transactions. The other is really, the whole focus. There was a reference to the bill desk deal. There's obviously the Baiju deal where the payments got deferred. There could be an extension and non-extension of long stop date. So the whole risk aspect of how do you protect yourselves against some of these elements, I think we're seeing a much heightened focus on those aspects. So I covered the deal structure, I covered the risk, and I would probably say that and Swati mentioned in the due diligence stage itself, we're seeing a lot of focus on, because of all the cybersecurity issues that have happened globally, we're seeing that as a fairly big focus. And value creation, which Swati alluded to, right? The fact that it's much earlier in the stage of discussions when we're working with private equity or strategics as to how do you really create value or preserve value or accelerate that, are elements of due diligence that we're seeing a lot more focus on. And probably some of the discussions on integration, which Swati mentioned, happening much earlier in the deal. So these are some of the shifts in terms of approach that we are noticing in the marketplace.
Excellent. I think some really fantastic points being made by Sundar and Shivani there. I'm sure the audience will deeply appreciate that. Bit of talk about valuation, I think, which leads me to my next question actually for Nidhi, who's finally into the webinar after 30 minutes. I think, Nidhi, there you go. So valuation, very important point, right? I mean, oftentimes as a sell side, you will value a company well more than what ordinarily one should. But that has led to significant mismatches, right? I mean, we have seen some of the companies being listed and really their prices have come crashing down and the valuation mismatch has been exposed. In terms of deal making, what do you think? How is the tech sector valuation, where it is heading? And how do you really bridge the valuation gap between the buyer and seller? Deferred consideration, foreign exchange challenges, and some thoughts around that, please.
Right. Thanks, Prasanjit. I think that's an excellent question, especially given the current sort of funding environment that we're all in and reading about. I think like a lot of my fellow panelists have also mentioned, we've seen the sector perform exceedingly well over the last couple of years. We're now seeing maybe some muted activity for a whole bunch of reasons that we've all discussed. But that's not to say that there is no liquidity or dry powder in the market. I think everyone here will agree that there is the ability or potential to buy, but I think the approach to the buying has become a little more conscious and cautious, and to that extent it has played a direct impact and role on the manner in which valuation and pricing discussions are being undertaken. So what we're really seeing a lot more of now is if there is a valuation mismatch or a gap, then parties are quite open to having discussions on innovative deal structures and to see how they can use different modes of structuring to bridge this valuation gap. Some of the ones that I'm seeing more often than not are maybe three. I'll start with the first, which is a deferred consideration structure. This is becoming increasingly popular only because this really helps manage the risk of underperformance after completion of the acquisition. So you don't, as buyer, have to go and pay for the entire deal consideration on the closing date, and you do hedge your risk to some extent by holding on to some of the deal consideration value, which is often linked to milestone based triggers. Of course, as Monica was also talking, that there are some regulatory hurdles when we talk about structuring and the like. What we're seeing now, especially in this environment, and someone mentioned consolidation as a key theme as well, is companies which are actually capital rich are looking at this environment to make other inorganic or strategic acquisitions. And when they do that, they are often companies that we refer to as FOCCs, which are foreign owned and controlled companies. When such companies want to undertake a deferred consideration type structure, the regulatory sort of considerations become meaningful because the law is currently unclear on whether this is possible to do or not. Of late, this has become challenging to implement when you are dealing with an FOCC. And so when you talk about M&A deals and the company in question that is looking to acquire the target here, this becomes an important structuring discussion to have at the beginning, because this is not a solution that would work for all cap tables. One of the other valuation sort of innovative structures that we're seeing is a put and call option, which is now being used to bridge valuation gaps. In such structures, the seller is usually left with a minority equity stake in the company, and the parties, both the buyer and the seller, have the benefit of an option to require the sale of that stake to the buyer at a later date and at a price which is usually based on a metric. Such as the multiple of earnings or revenue, and is of course subject to certain conditions. So what this does is the seller actually takes some exposure to the trading of the business during the option period, but also has the opportunity to realize value beyond above that if of course the company goes on to perform well. This also allows the buyer to ensure that this element of valuation is actually supported by the actual performance of the business during the option period and is not only linked to the valuation discussions between the parties. And the last one that I'm seeing, again, is a tool as old as time, is of course earnouts. Earnouts are essentially a structure by which some of the purchase price is calculated by reference to the future performance of the target company, but instead of being tied to one metric, this is typically tied to more than one metric, which is a combination of financial or non-financial measures. This really helps the buyer get the correct value out of the business and also acts as an incentive for the management as they continue to have skin in the game. So this is really some of the ways in which that I'm seeing valuation gaps being bridged. And I think parties are very incentivized to actually come up with structures that allow deal making to happen, as opposed to letting a valuation gap kill the deal.
Excellent. I think we've hit the nail on its head really in terms of some of the really techniques to bridge the valuation gap. Shivani, you want to supplement in brief to what Nidhi just said?
Actually, Nidhi covered it so comprehensively. I would just want to add in, as the environment is getting a little tough, what we are trying to do more as advisors, we represent a lot of founder-owned businesses. And what we are looking to do is, how do we mitigate the downside risk? The growth environment in an earnout structure is uncertain. How do you decide the measurement period? How do you decide the measurement criteria and the thresholds so that the founders have a reasonable protection for the fact that the future is uncertain? The other technique that we use is, how do we maximize the benefit of synergy, which is not lip service, but it's actually on paper, and the sellers can benefit from the synergy because really their agenda is to be part of a bigger ship. And how do you actually sort of realize it in terms of mathematics and formulas that go into determining consideration? And the other technique that we are using a lot is also catch-ups, because again, the time is uncertain, we don't know how things will pan out. So I think some of the nuances to what Nidhi mentioned, keeping in mind the environment, are techniques that we are implementing in addition to try and protect a lot of the founder-owned businesses that we represent.
Terrific, Shivani. Thanks for that. I think earnouts in itself is such a vast topic, and there's so many nuances to earnouts, how to implement. So I think we have done, as part of Master Series some time back, detailed webinar just on earnouts and purchase price adjustment. It must be on the YouTube playlist. So please feel free to take a look if you want to dive into some of the details around earnouts. Moving on, I think Karthik, the next question is for you. Now we slightly change gears. I think management incentive plans. We all know about ESOPs, but how important is that in terms of tech M&A to retain talent and also in the context of exits. So can you shed some light about management incentive plans in the context of the tech M&A deals?
So percentage is getting more relevant. I mean, especially even mid-market deals now. I mean, the whole option payment plan, the management incentive plan. What is the capital expenditure to that? What is the cash flow cash flow outgo at the beginning of the deal for MIPs and option plans? Those are all items you have to take into consideration. I mean, and they're just getting larger and larger. I think we know one famous cross-border deal into India, where obviously it was a large e-commerce business which got bought over by US MNC. I mean, there alone, the option plan payments as part of the transaction were almost $800 million plus. So that just gives you a sense of numbers, which people now have to take into account, when you're planning a transaction. How do we figure out the management incentive plan? How do the options accelerations work? What will be the option payouts on first instance, on change of control, etc. That's something you've got to plan for. I mean, lots of permutations, combinations on the table. If I was a buyer, how can I convince option holders to sort of move to my option plan, to my option pool in the future? Maybe if there's a bullet payment upfront for change of control, how can I stagger that? Can I make a payment upfront to them, but then defer a large payment or defer a large portion of the option entitlement or the option vesting or the option exercise to perhaps to my own option plan, where I give them a larger, maybe a larger pool entitlement than they have right now. So that's something I've seen on the table, where people want to say, look, how do we incentivize management to move to our own option plan instead of taking the the one-time cost upfront? There are other factors which come into play here as well. I mean, from a purchase price adjustment, this is going to result in a cash reduction in the target company, which is going to be paying the option holders. There's also going to be a 40% tax withholding on whatever option payments you make to your option holders. So how people plan for that. Is this going to be a transaction expense? Will it be deducted from the net cash for any purchase price adjustment? And just because of the size of these things now, I mean, it makes people think about, look, how do we plan, how do we really make sure incentives remain aligned on an M&A transaction when you're looking at a large option pool? The other things, I picked up from, due diligence exercises is that, look, even if you want to amend the option plan, you want to have some flexibility there where perhaps you want to defer some things, pay some things upfront, move them to your own option plan data, etc. Can you even do it without the option holder's consent? So, for example, we've seen a number of option letters or option grant letters or exercise letters or vesting letters where, frankly, the way it's designed, you have to go back to the option holder's consent. You can't just unilaterally make a change by making the board do it. So that's some homework you got to do, perhaps at the time of DD, at the time of transaction planning, is how much flexibility can the target, the seller, the buyer have in changing around the option plan. I mean, those are just some recent learnings on this, and I mean, this is evolving. The other piece I've seen is, India is a difficult market to enforce a non-compete. But if you link your non-compete to an option plan vis-a-vis an employment agreement, can you sort of get around the law which says that you can't have a non-compete beyond the term of employment? So those are some places where people have been innovative, tried to use the option plan as a buyer to their advantage as well. But again, on management incentive plans, we've seen some really smart management incentive plans out there for tech companies, which are in the public domain for listed companies, where they're sort of linking the IRR or the exit or the payouts to, let's say, the entry cost of the investor versus the exit of the investor. And these are listed company deals we're talking about. So I think I think this one is not cookie cutter. It's really dependent on the option pool you're trying to retain. What kind of company are you? What's the competitive landscape? What's the what's my retention plan, etc. So I think every transaction is too bespoke for management incentive plan or option pool. I think you just raised a few topics, which could be of relevance. So 100% something to plan for as you value transactions with large option pools. Back to you, PC.
Thanks very much, Karthik. I think some excellent points we made. Especially, I think the broad sense what you're saying, possibly management incentive plan can be a great hook, to kind of retain talent or even to get around non-compete, which are so notoriously difficult to enforce, and it's not easy. So I think that's some excellent points we made there. I think moving on to the next question is really about this is a Sundar really, and I think, Sundar, in your assessment, with a threat of global recession looming large, as I think at the outset mentioned, how is that likely to impact tech deal making? And what's the outlook, in your assessment? Some crystal ball gazing, but I think I can think of no one better than you to do that. So yeah, over to you.
Yeah, I think, in our profession, you always need to be an optimist, right? So, my view is I'm I'm an optimist here. So, but see, I don't think anyone here has the ability to sort of precisely forecast whether there's a recession, how long the recession is going to be, how deep it is. I think we are all hoping it is a short one, if there's one, and we sort of quickly tide over it. Now, what we think about the impact on M&A is we don't necessarily believe that this is going to lead to a slowdown from an M&A perspective. If you look at it historically, India has seen such periods of time in the past. What has really worked for a country like India is periods of slowdown are also periods where there's a lot of activity which flows into India. If you look at the whole tech services part of the business, generally that has been a business which has rebounded pretty quickly. Maybe there are some near-term hiccups which are there, and then sort of rebounded pretty quickly. Two, the sort of work which is being done even on the tech services side is now undergone a sea change. We are spending more time on engineering, R&D services, product engineering. So there's a lot of work, and it's still sort of pretty cost efficient and even technology efficient, capital efficient from having these services from India. So in general, yeah, I don't want to say that we are decoupled or anywhere close to that, but in general, we might actually be able to sort of come out of this in a much better way than probably some of the other regions. And that's going to sort of bode well, even from a M&A perspective. And that's really what sort of happened. Our public side analysts put out a research paper about a week back, which sort of called the next decade being sort of India's decade. Now, I don't want to sort of forecast what it is, but if you look at it, India seems to be in a place where the bank balance sheets are strengthened, the corporate balance sheets are in a good place, and you have sort of reasonable clarity and certainty from a policy directive. And India is also sort of diversifying from a services-oriented economy towards more manufacturing-oriented economy. So when we sort of think about all these things, look at what has happened in previous cycles from a technology space, clearly India has been one of the beneficiaries of this. So, we continue to be pretty positive in terms of the outlook for M&A in general and tech M&A in particular.
I think that's an excellent insight, really, on what's kind of lies ahead, and given the current challenging situation which is brewing. Shivani, you want to quickly supplement what Sundar said?
I have little to add to what Sundar said, and very eloquently. When we look at least our view is, when you look at the whole deal activity, there could be some headwinds, as it and no two recessions are the same. Each has their own unique attributes and its impact. This one, as and when it happens, obviously is going to have a meaningful impact on the cost of capital and the financing, and we've seen that typically impact large deals more. Right now we're seeing a more sentimental impact on financing, also private equity funding that is available. But if you look at the capital activity and the kind of cash reserves, the kind of funding that happened, and we reference the unicorns and the kind of financing that has happened in the last 24 months, the kind of dry powder that is really in the marketplace. And as even McKinsey's own research says, that if you buy during such times, those companies actually outperform their peers. And just borrowing that thought, we do believe, as Sundar said, that there should be more specific M&A activity that will happen, more strategic. It won't. I think we may not see large volumes, but we'll see strategic activities continue. From a seller's point of view, this is unique, that how does these trends impact a seller? And we think that from a seller point of view, if they are able to, and we are able to build some of the risk mitigants that Nidhi and I spoke about, right, and the ability to try and be part of a larger ship, I do believe that it does make sense for certain sellers to explore this timing as well, because there is still a premium to be had. You see, there is a high valuation bar that was set. There is a certain last 5 years, 7 years averages that's it. And today, I think there is a scarcity premium to be had. And therefore, from a valuation point of view, through innovative structuring, a lot of sellers can benefit from really also participating and not losing out to more structural changes besides recession that is driving M&A.
Excellent. So that's very helpful supplemental points, Shivani. Thanks for that. If I can move on to the next question, I think it's more of in terms of structuring, and this is for I think Nidhi and Karthik. In terms of offshore structuring, and especially flip structuring, is it increasingly being used more commonly to implement tech M&A deals? And if so, why? And I'm sure like any structuring entails fair bit of challenges, impediments. So what are the impediments you see in resorting to a flip structure or offshore model?
Right. So I think especially in the tech sector, right, where most companies are, say, asset light, if you look at some of the sectors we have been talking about, such companies typically do prefer to flip offshore because they believe this allows them access to foreign markets and foreign funding. A lot of investors who are also looking to pump money into these companies or eventually acquire these companies are comfortable investing in friendlier jurisdictions like US, UK, or Singapore, primarily because maybe there is some lack of knowledge of Indian foreign exchange and securities laws. So we do see tech companies prefer or at least want to understand what the flip or the offshore structure means for them. Is this something that they should consider, and whether it's possible given the stage and scale at which that company operates at. So I would say certainly as a trend, I do see the flip and the offshoring structure become more and more common, especially in this sector. What was becoming a challenge was, of course, the manner in which this is possible to do given India's foreign exchange regulations. But very recently, the RBI has revised these regulations to try and sort of make this more friendly, assuming the conditionalities that have been laid down by the RBI are satisfied with. So I won't get into the technicalities or the details specifically of what the regulations seek to do, but safe to say that if today you are a tech company that is looking to set up a holding company offshore, which is imagined in India by Indian promoters, then it is possible for this structure to be done without necessarily requiring prior regulatory approvals in India, assuming, of course, all the conditions that are now set out by the RBI have been complied with. We've also, of course, gone on to see under the previous regime where companies have successfully flipped and then gone on to also list on the NASDAQ. So I think we have also seen the entire life cycle of some of these businesses go from incorporation to public listing. But yes, the new regulations are very new. So there are, of course, some T's to be crossed and dots to be, and some I's to be dotted, but I'm sure we'll get there.
My personal sense is just where we are. I think this whole, I think I can see personally the inquiries for the flip structure coming down. It's not as exciting as it was maybe 18 to 24 months ago. Lots of reasons for it. One is obviously it was easier to do a de-SPAC with an overseas company. With the whole SPAC market cooling down, I think, people are not so excited about the offshore flip right now because, I mean, the SPAC transactions, I mean, at the moment are just not there. The second one is, I mean, the more, like Nidhi said, the more asset light you are, the more early stage you are, just easier to do the whole flip structure, avoid the Indian capital gains taxes and other issues and the PE issues and the permanent establishment issues. I think the more you become a more mature company, more growth, kind of harder to, from a tax perspective and leakage perspective, justify the flip later. And I think the third thing is, Indian capital markets have been okay. They've been valuing IT services, tech companies. I mean, are they as good as NASDAQ? Do they give the leverage which a NASDAQ listing gives you? Perhaps not, but they've been. I think they've sort of been. They've been there. They haven't completely evaporated. So it's given people more reason to sort of think twice about reconsidering the whole flip structure. But yes, I mean, for more ambitious tech founders, who have a product they can export, who have a business model which is slightly, with more broad vision. I think that structure still makes sense, and I think the new ODI regulations which we have sort of enables it very nicely. The earlier the whole issue around round tripping, a lot of those concerns have been eliminated. I mean, yes, there are some crinkles, there are some issues you need to watch out for, you need to solve for as you go along, etc. But yes, on the whole, simpler. And I think the other good news is people have done so many of these over the last 3 or 4 years. They know what to watch out for or what to solve for. So that's the other good advantage of sort of trying to think through a flip structure now.
Terrific. So I think again, broad takeaway seems people have perhaps overused it, and it's perhaps a bit of waning down of interest, but still enough potential in light of the regulatory changes which are in the positive, perhaps to keep an eye out and really consider it. So I think in the audience, people may keep a note of that. I think moving on to the next question, it's really on, well, before I go do that, I might just do a quick shout out for the audience. This is a special edition we are running today. It's a 1 hour, 30-minute session, so we will conclude at 4 p.m. So we still have 15 odd minutes to go to wrap up the panel before we take audience questions. So stay tuned. I think next question is on commercial due diligence and due diligence generally, the approach, how it has changed in tech M&A deals context. Monica and Swati, if I may request you to take that up, the approach to due diligence. Very wide canvas, I'm aware of that, but some key insights customized for tech M&A deals would be very helpful.
I'll probably start, and Monica should add, right? So we typically do, right, 20, 30 commercial due diligences every year on just tech assets. And I'm a leader in the private equity practice, so I have seen the evolution of commercial due diligences, right, over the last couple of years. And the way I would sort of summarize this, Prasenjit, is that, see, financial and operational health is hygiene, right? So that goes without saying, I won't even get there. Having an attractive TAM, right, target addressable market, is another hygiene factor which everyone is looking at, so I won't get into that as well. But a few things that are not as important anymore, and buyers are not looking at them so critically, are essentially, what kind of installed base of customer is the asset bringing, right? It doesn't matter, to be very honest. Does it help me expand more geographically? Right, I would say it's not as important. It could be something that they get as a collateral, but it's not the most important aspect of looking at an asset. Right. Similarly, just pure scale-based acquisitions are far and few now. What is emerging as more and more important from a buyer standpoint is, number one, what is the differentiated and unique capability that I'm bringing, which cannot be replicated, right? So that's the first thing that we see. I remember a time, I guess a few years back, when it was good enough to say, hey, this asset has digital capabilities, right? If I just talk about tech services, not anymore, right? Buyers are actually interested in knowing which part of the value chain are they playing in, what capabilities are they bringing, what kind of talent do they have, which is differentiated, because at the end of the day, talent is a talent, right? Like engineers are engineers. So what are they doing so differently, which others are not able to replicate? Are they training their people differently? Are they doing something which is over and above the hygiene? So that's the first thing that we are sort of seeing. A lot of scrutiny, a lot of deep dives into just capability and what differentiates the capability. And the second aspect that we are seeing, which is becoming very, very important, is, I said previously, not so much the installed base of customers, but the stickiness of the customer relationship, right? What is it that they are doing that the customer will continue to engage them in long-term contracts, right? Thereby making the business more and more stable and resilient over the longer time frame. So these are the two aspects that we see that buyers are spending a lot more time in establishing if the asset is going to survive in the long run on the back of core capabilities that they bring to the table and truly differentiated, which puts them a peg above everyone else. And second is the stickiness of what they are providing as a service and the customer relationship, whether that's stand the test of times. So that's how, at least, again, restricting ourselves to just commercial due diligences, that's what I see is changing very dramatically over the years. But Monica, would love to get your perspective as well.
Sure, sure. No, that's very interesting, Swati. I would say that there is a similar trend for the legal diligences, but not quite as dramatic. So what buyers are doing for legal due diligence is that they've made it highly specialized, because they are so focused on several of these business aspects that you were talking about. The diligence is that much more specialized, and they're looking to solve these kind of problems through the diligence process here, right? The other reason why this has happened, and I think we touched upon this and spoke about it at length earlier on in this webinar, is how the landscape on regulations has shifted a lot in the last few years. There are so many sector-specific regulations for fintech or edtech or other segments. Plus, there are these specialist aspects around data privacy or antitrust, and all of that means that there is that much more time and effort spent doing your regulatory due diligence. So I would say that highly specialized diligences are kind of the flavor for tech M&A deals. The common sort of issues that you would find in legal due diligence, I would list three top areas. So I would say regulatory compliance, data privacy, and intellectual property. And these are sort of traditional areas that we've looked at, but the way they have changed is because the regulations have changed over the years. So on the regulatory compliance side, we would look out, of course, for the FDI policy sectoral conditions. And then there's the entire set of sectoral regulations. So you have, your UGC and MHRD stepping in when it comes to edtech companies. You have RBI for payment companies. You have IRDAI. So you're looking at all of these regulations. Over and above this, there are the cross linkages. So for example, a number of fintech regulations will also have restrictions or requirements around data privacy or security. If you look at the edtech regulations, they're not just talking about the edtech side of the business, they're also saying this is how you must do your advertising. This is how you set up your subscription model or your payment model. So there's actually a lot of cross linkage when it comes to regulatory aspects. Moving on to data privacy, I think this is very, very common, especially for early stage companies. The typical sort of issues that we find are deficiencies in the privacy policy. Another issue that we very commonly see is that jurisdiction-specific compliance checks or audits have not been undertaken, even though the company's business or its platform is freely available to users outside of India. And that is a fairly big exposure for the buyer, for the target company, and therefore something that you need to carefully look at. A related aspect is around data security. I mean, technology companies, by the very nature of their business, are more vulnerable to cybersecurity hacks and things like that. And that brings you back to the point of the shifting regulatory landscape. The new certain directions have been very much in the news for their aggressive 6-hour timeline for reporting incidents. So things like that, I think you have to continuously keep track of these sort of regulatory changes and make sure your diligence is picking up on those aspects. IP is another significant area for the diligence. Very often you'd find that startups which have grown quickly have not had the opportunity to maintain their IP protections the way an investor would like, or have not, for example, had the opportunity to go back and look at the standard form agreements that they adopted early on in their journey and how they may need to change with the evolving needs of the company. So a very, very common issue that we often find is around how IP is assigned by any independent consultants who are engaged by the company, and whether that is robust. Very often we find that it's weak or it's legally deficient, and that requires fixes or remedial measures. Another aspect that often comes up in diligences is how companies in their startup stage register certain IP in the name of their promoters, or they do not pursue registration in all the classes of the needs classification that an investor would like for full-fledged comprehensive protection. So things like that in terms of protecting the IP of the target. On the other end of the spectrum, it's also important to sort of adopt the right kind of measures and protections to not infringe third-party intellectual IP and therefore protect yourself from claims and litigations. And is an area that seems to have been missed by startups. So I would say that's the sort of overview of the diligence issues that often come up. I think over to you, PC, if you want to continue ahead with.
Yeah, no, I think some, again, terrific points being made by Swati and Monica. Thanks for that. Really, again, I'm mindful that diligence itself is such a vast topic. It's impossible to do justice in a matter of 5 minutes. So again, incredibly well done. And for the audience members who wants to know buy side, sell side perspective of diligence, we have done dedicated webinars on this. Again, I think YouTube playlist of Ketan will have that hopefully. Moving on to the next question. This is for Nidhi and Shivan, you can supplement Nidhi. This is really more on the use of non-cash as a consideration to implement some of the tech M&A deals, whether it's shares, and how do you see that playing out? Is that increasingly be used more and more? If so, why? What challenges do you foresee in that? Benefits? Some light on that, please.
Thanks, Prasenjit. This is also something Sundar, in fact, mentioned briefly earlier into the webinar as well, that this is a key trend that I think some of us are seeing for sure come out of the current deal-making space in the tech sector. I would say yes to your question. Is there a trend towards non-cash M&A deals? The answer is certainly yes to my mind. It has made M&A deals more convenient for buyers, who would otherwise require further financing, which would add to cost and additional terms for a buyer. So if buyer has stock that is sort of being used as acquisition currency, then that is something parties are exploring more and more. The main distinction that really I would say between cash and stock transactions would be that in a cash transaction, really it's the buyer who is taking on the entire risk, that the expected synergy value which is embedded in the acquisition premium will just not materialize because they're all in with the money and the sellers have in some ways completely exited the business. But if you contrast that with a stock transaction, that risk is being shared with the selling shareholders to the extent that they continue to hold stock in the company. So you see that this is something that buyers want to do more and more in the current funding environment. When you talk about a non-cash deal, of course, it goes hand in hand with all kinds of like tax issues that come to light when you're dealing with a structure like this. Tax issues can get tricky, but I think the big picture difference that I would highlight here between a cash and a stock deal is simply that when a seller receives cash, it will become immediately taxable because the seller must at least pay one level of tax on the gain. But if a portion of the deal is with acquirer's stock, then the seller can often defer paying that tax, and this is probably the largest tax issue to consider, and these implications play prominently in the deal negotiations when this is the structure that you're looking at. Some other points that do get hotly debated when you're looking at this structure is the manner in which interim control and decision making has to be done till the seller is also part of the cap table. So you'll see parties often engage in some kind of rights that will probably be given to the seller depending on how much stock is being given to them, etc. So one should be mindful of that. And of course, in India, we have very many different ways in which a non-cash transaction can be structured. It could simply be a contractual swap, it could be a court-approved merger. So there are various different ways in which this can be structured, and there are pros and cons to each of these. But it's important to have these conversations at the time that deal structuring is being done, so that parties can align on what is the most efficient way to go forward with a non-cash transaction.
Excellent. So excellent, Nidhi. Thanks very much for that. Shivan, do you want to supplement to that?
Again, very comprehensively covered by Nidhi. What we probably, I just like to point to, we do a lot of cross-border deals, and what we've noticed is, and perhaps from an India deal-making point of view, which could be far more enabling, is the ability to do cash-free mergers without a lengthy court process. I think specifically private companies, if to begin with, right, keeping in mind the deal sizes, and I think that would be one area which I think will really enable a lot of creativity and fuel deal making in a comprehensive way. The other aspect is the ability to roll equity in a lot of private equity transactions that we do. The founders can roll equity; it gets reset at the current value of the company without triggering taxes. And some of those mechanisms, and if our regulations can enable those mechanisms, I think it brings up higher alignment of interest and motivation in terms of how the value creation plays out. So I think it would be good to see if, as our regulations evolve, some of these enabling aspects could be put together, so that the overall deal making and the ability and the mechanisms that you have to be able to structure it are you have lots more tools in your armor, if you will.
Right. Again, some terrific points there. Thanks very much, Shivani. I think mindful on time of the clock now, and it's time to open it up and take some audience questions. And as you can see, I'm distracted with my phone because questions are pouring in, so I just need to filter them as I speak. Let me start off with the first question. Really, I think I can say, Sundar, you go for it, but please, others can chime in. Have you seen any recent changes in venture capital PE attitudes to investment in tech M&A, and why has that occurred? Maybe some parts of it we have covered, but it would be good to maybe respond to this specifically.
Yeah, I mean, I think in line with the general slowdown you're seeing in the funding environment, I mean, India has also seen a similar sort of a slowdown. However, I think what is still pertinent is the amount of capital which is still available with the private equities and the VC firms is still substantial. I think people are just waiting for, in my view at least, the markets to sort of stabilize a little bit. I mean, we are going through a period of unprecedented rate increases, which we haven't probably seen for decades. People want things to sort of stabilize. When it comes to tech and tech-enabled sectors, clearly, one thing coming out of all of this is, I mean, tech is here to sort of stay. It's an enabler for every sector, and that's going to be there. Valuations is a function of the market conditions. I mean, that could go up and down. What people really like is sort of stability. When the market sort of stabilizes, we would expect the deal momentum, deal activities to sort of come back in a pretty meaningful way again. I mean, as long as the uncertainty is there, you expect it to be a little bit muted.
Right. That's very, very helpful. Anybody wants to supplement Sundar on this? We can move on to maybe the next question. I think next question is on rollover transactions. I think there was a mention by Shivani, but maybe Karthik, you can throw some light on this. Rollover transactions workable for founders in M&A exists today, given the current tax and foreign exchange environment.
No, thanks. I think Shivani touched upon it also. Thanks, Shivani, for bringing it up. I think most of us on this panel will agree that one of the reasons in the tech space there's been so many bolt-on or add-on acquisitions, as they call it, by these IT services platforms which are private equity owned. They are the most prolific M&A transacting parties at this point of time, because I mean they're all trying to aggregate, do more roll-ups into their platform, make the platform larger. Obviously, sum of all parts is going to be and if they can do M&A right now in a slightly slow market, hopefully at a 3x, 4x, hopefully at the time of exit, the platform itself will go to 8x, 9x. That's the theory, and it's a well-founded theory. And I think just that whole bolt-on add-on piece for private equity-owned aggregators or holdcos or platform companies. I think rollovers really, I mean, for them to really make it happen, I think rollovers are very important criteria. They need to make, and to my mind, it solves for three things. One, it solves for any valuation gap. You sort of bridge the valuation gap by giving the sellers or the sell side a nice piece of the rollover platform. It gives you skin in the game, so it's a nice management incentive. Third, it's a slightly new and maybe perhaps a more scientific approach to an option pool for an already well-established set of sellers. It gives them a much more significant upside than an option pool can give them. So it could work in three ways. Capital gains taxes are the number one issue, I think, in any Indian rollover transaction, because nobody wants to pay CGT for a cashless transaction, and a rollover to an extent is going to be partly cashless. Even if it's money in your hands and reinvesting it back, you're going to reinvest back tax money. And of course, the fact that swap of shares is not very easy from an FX exchange control perspective makes it kind of harder. I think the third thing that makes it harder is India's entire restriction that no Indian resident can invest more than 250,000 per individual per year, then you've got to look for more funky and more innovative ways to make sure that the rollover is done, and it's the economics are preserved even without that much capital going out. I mean, we've seen lots of variations around this. One variation is on the actual purchase price. Let's say it's $100 million deal, only 70 million is paid, because 30 million is then held back on the top co as a slice as your rollover component. It's not the classic US rollover where I give you 100 million in your pocket and then you put 30 million back, and therefore that's the rollover component. So there are going to be variations around this. Again, it's going to be very heavily dependent on each person's residential status, tax domicile, and just generally, like I think Nidhi mentioned, this is a really early one to talk about at the time of transaction structuring. I mean, if you miss it then and your transaction progresses, it's going to be hard to catch up and solve for it later.
Excellent. I think that looks like a tailor-made question for you, Karthik. You just bounced on that. So I think that's I think given your bolt-on experience, I think that's been something which you have very passionately responded to. I think perhaps I can squeeze in. See, there are a lot of questions on ODI, and I'm consciously not taking them on because I'm taking questions holistically, addressing M&A tech space rather than ODI. We respond to that separately, but for the benefit of what we are dealing with here, I'm just broad-basing the questions as much as I can. I think it's an interesting question. I'm not very sure I connect with this question. The question being, is it more difficult to do M&A deals in tech space currently, and if so, how? Maybe Monica, you can have a stab at it. Maybe Swati, you can supplement. But is it really challenging to do M&A deals in tech space nowadays in comparison to yesteryears, maybe? How is that?
Yeah, I wouldn't necessarily say it's harder to do tech deals, Prasenjit. I would say deal making has certainly changed now. It's become more intensive in certain ways. If you just look at all of the aspects, all of the issues we've been talking about in this webinar, the specialized diligence, the regulatory compliance that investors are very keen to understand early on in the deal, all of the structural issues that people are exploring, flip structures, offshoring structures, bridging valuation gaps in terms of earnouts or deferred, all of that means that there is more time and effort being spent in the initial stages of the deal and in order to get a deal to closing. And I think what all of this also means is I would say two things. One, it means the deals are that much more multidisciplinary. The deal lawyers have to work with the other advisors on the transaction to bring things together. Equally, the M&A lawyers need to work with the specialists to sort of closely, understand and resolve any specialist issues around data privacy or IP or whatever else. The other thing that's happened is deals are often multi-jurisdictional because either companies have already flipped or they're looking to do that, and to the extent that is involved, you are looking at multiple geographies. So overall, I would say in a nutshell, what it takes to successfully execute a deal is more focused effort and more coordination, and in that sense, you could say it's more intensive. Definitely not harder, but maybe Swati, you can tell us your views too.
Yeah, no, I think I would agree, right? That the shape and form has changed, but probably along with that, right, all of us professionals as well as even enterprises have become more mature and they have sort of built the muscle, right? And they are evolving constantly. I think the only lens that I'll bring is when it comes to strategics, right? I think enterprises are now thinking about really building an in-house capability, right, to both scan the market, find the assets, run the transaction, involve the right bankers, and so on, right? Like earlier, erstwhile, enterprises didn't have that capability, right? You would have like probably a one-member team just thinking about M&A, but rubber never really hit the road. But I'm seeing increasingly that some of the tech companies that Karthik was alluding to earlier, they're actually building the M&A muscle, right? Which essentially means, the entire playbook of figuring out which are the right assets in the market, when do we think about sort of acquiring them, the integration playbook, the valuation playbook, right? All of that, they're starting to build that muscle, which probably years ago, was probably very, very nascent, right? So that's at least one shift that I'm seeing, which is to sort of cope up with the changes and the fast-paced nature of the practice as well.
I think that really, I think fairly comprehensively responds to the question. So thanks very much, Marek and Swati, for that. I think maybe it's time to do a quick recap. I think some excellent points being made on a wide range of questions. So Nidhi, if I can request you to do a quick recap of some of the key points discussed in today's webinar.
Sure, Prasenjit, thanks. I think certainly being a very thought-provoking panel from my vantage point. To me, some of the key takeaways really would be that I think the first one being that tech M&A has, of course, been active over the last 2 years. We don't see that really changing. We do see some aspects of it changing, of course, which we spend a lot of time discussing on this webinar, but tech M&A is definitely here to stay. What we're seeing in terms of trends is that the M&A and the key driver for the M&A right now is mostly to build more digital capabilities and to add to the offerings of the acquisitorial parties. It's not really a number or scale game, but really to see whether there is more that they can acquire to add to their offerings. And to that end, what we're seeing translate into is the manner in which deal making is being done. So we're saying that risks are being identified early on, and the manner in which those risks can be mitigated is also being discussed early on. All the parties are really focused on preserving the economics and the asset that is being acquired. To that end, conversations around manner in which the valuation gap can be bridged, the manner in which management can be incentivized are all key points to bear in mind at the time of having these acquisition discussions. Preservation of talent is also an important sort of factor to keep in mind at the time of doing the M&A analysis. It seems that planning is the name of the game. So planning ahead, planning in advance, and making sure the transition and the synergy that you're looking to unlock from this acquisition is fully available to the acquirer is very, very important and should be identified early on into the process. The manner in which the deal structures are also evolving is becoming an important conversation. Buyers are doing deep dive into the capability that is being acquired. They're looking at whether businesses are going to be stable and resilient in the long term. So diligences and commercial diligences specifically are focusing on some of those aspects more so than before. And they're really trying to understand whether this asset is going to survive in the long run, given where we are right now and where the market and overall sort of global factors are at play. And I think I would end with the outlook that we've all discussed at the panel. I think net we all think that it's looking good, especially for tech M&A sector in India. We think that the next few years are really going to be essential for deal making from India's perspective. India is critical to the IT services and the SaaS sectors that we talk about from a tech M&A perspective. And hopefully that means that we're going to see lots more deals coming out of India.
Thank you very much, Nidhi, for a wonderful roundup and recap of such a long session. So exceedingly well done. I think now before we head to the conclusion part, I will request Mitesh, if you can put up the poll slide. It will be up there for 1 minute. I will request all of you in the audience to please take a minute to respond to the poll slide, sharing your feedback. We take this very, very seriously as part of our continuous improvement program. There you go. So I think in conclusion, I think firstly, I would like to thank each of our guests for sharing their experiences and expertise with us today. Swati, Shivani, Sundar, thank you so very much. We're outstanding. Without you, this webinar obviously would not have been possible. You each did an outstandingly good job, and we are very much indebted to you. To our audience, I hope you found this webinar an interesting one and worthwhile investment of your time. A lot of practical aspects in this one with the blend of theory. We certainly thoroughly enjoy bringing it to you. After this webinar, as I mentioned at the outset, we will send you a copy of the summary notes, sharing a recap of all the key points, a link to the recording and the slide decks. You will also separately get a request form for your feedback on the webinar. Please take a minute to send your comments, criticism, and even compliments. It will take barely a minute, so kindly do that. Please do not hesitate to reach out to contact us in relation to any matter concerning this webinar or otherwise. Our contact information is in the contact slide at the end of the webinar. Thank you for your attendance today. We look forward to again be of service again at future webinars. This has been the last webinar of the series, and this has been the most, I would say, registered and attended one. So really goes on to show that perhaps we deserve the very best for you till the very last. So thank you very much, and see you soon. Take care.
Thank you.
Thank you, everybody. Bye.
Thank you.